How does that shift affect long-term mortgage rates? And should buyers be optimistic right now?
Well, first I'll say yes, they should be optimistic. Now, in terms of the backdrop here, in terms of the inflation rate level and long-term rates, mortgage rates, what's the interaction there? What's the correlation there? First thing to understand is, inflation, especially higher inflation, that's the enemy of bonds, and of course, bonds are essentially fixed rate, fixed yield investments. And so when you own that kind of asset, you don't want to see higher inflation because given that that asset is providing a fixed yield, well, in an inflationary environment, that higher inflation level diminishes the value of that inflation of that interest yield on your fixed asset, and it pushes down the value of that bond. So so I know that's all kind of technical, but understand that most mortgages serve as collateral for bonds. FHA, VA, USDA, they're collateral for Ginnie Mae securities. Those are Ginnie Mae mortgage-backed bonds. Mortgages are secure that are insured or guaranteed by the government. And then, of course, there's MBS, mortgage-backed securities. Those are the kind of bonds sold that are collateralized by conventional loans, mostly Fannie Mae, Freddie Mac. So the basic idea, again, these are fixed yield assets. So when you have a situation where inflation is rising, it diminishes the value of those bonds, and that's what's going to push mortgage rates up. So you want to understand that that's the relationship, and that's why it's so important that as we get closer and closer to the Fed's inflation target, that should be, barring other factors, that should be helpful in getting rates lower than where they're at now.